They called Michael Burry crazy in 2008 until he was proven right. He's built a reputation for going against the market when everything was at its peak. His latest portfolio changes are no exception. He's exiting some sectors entirely and betting big on others. In this video, I'm going to show you the pattern Michael Burry is seeing, why he's investing in different markets, what his most recent sold and bought stocks are, and most importantly, what his strategy means for your investments. Alright, let's cut to the chase. What did Michael Burry say goodbye to in his portfolio? First up, Burry completely sold out of Hudson Pacific Properties, all 1.1 million shares. This real estate stock is made up of over 10% of his portfolio, so this isn't a small decision. Given the struggles in the real estate sector thanks to rising interest rates and slowing demand, this move isn't shocking. Still, it is a bold exit. Next, Biota Incorporated also got the short end. This is a smaller position, around 1.66% of the portfolio. While it's not a headline grabber like his big sells, it's worth noting that Burry seems to be trimming anything that doesn't align with his high conviction bets. American Coastal Insurance also got a massive haircut. Burry reduced his stake by 60.3%. Why? Likely a combination of shifting market conditions and Burry's strategy to consolidate his portfolio. Insurance stocks can be tricky in uncertain times, and it seems like Burry's pulling back from the sector altogether. More on that later. Lastly, there's Real Inc., a luxury consignment platform. Burry slashed his position by 50%. Sure, luxury goods might seem recession-proof, but online platforms in this space are struggling to maintain margins. When Burry sells, it's rarely random. If you look at his portfolio, there's a clear trend. He's stepping away from real estate, small caps, and higher risk plays. Selling out of Hudson Pacific Properties makes sense. The real estate market has been hit hard by rising interest rates, making it expensive to borrow money. This puts pressure on companies that depend on debt to grow or even survive. Reducing his position in ACIC suggests that Burry isn't keen on holding on to financials during volatile times. Insurance companies face unique challenges during market downturns, and Burry seems to be cutting back. Let's not forget his tendency to streamline his portfolio. Burry's always been known for making concentrated bets. He's not the guy who owns 50 random stocks just to play it safe. By selling these positions, he's likely freeing up capital to double down on his high conviction ideas. We'll talk about those in a couple of minutes. Now that we've covered what Burry has been selling, let's flip the script and look at what he's been buying. This is where things get exciting. If his selling were about closing doors, his buys are like opening new ones with confidence and purpose. First on the list is JD.com, one of China's largest e-commerce companies. Burry went all in, doubling his position by adding 100%. That's now 24.08% of his total portfolio. Clearly, he is seeing something big here. Perhaps it's the growth potential in China's e-commerce market, or maybe it's a belief that the Chinese economy is due for a rebound despite recent slowdowns. Whatever it is, JD.com has become a cornerstone of his strategy. Right behind JD.com is Baidu, often referred to as the Google of China. Burry increased his position by 66.67%, making it 15.85% of his portfolio. This aligns with his growing interest in Chinese tech, and let's be honest, Baidu is more than just a search engine. This company has been heavily investing in artificial intelligence and autonomous driving technologies, two sectors with massive growth potential. Next up is Shift4 Payments, a company focused on payment processing solutions. Burry increased his stake by 50%, bringing it to 16% of his portfolio. This one's interesting because it shows his confidence in fintech and its ability to thrive even in turbulent markets. Shift4 has been growing its presence in the hospitality and e-commerce sectors, two areas where digital payments are becoming essential. Speaking of tech, let's talk about Alibaba. This e-commerce giant now makes up 25.55% of Burry's portfolio after he added another 29%. Like JD.com and Baidu, Alibaba is a major player in China, and Burry's move here solidifies his growing faith in Chinese tech. Sure, the company has faced regulatory changes and slower growth recently, but for someone like Burry, it might make for the perfect time to buy, when sentiment is low and valuations are attractive. But Burry isn't all about tech. He's also been making investments in healthcare, specifically with Molina Healthcare. He increased his position by 22.3%, making it 12.45% of his portfolio. Molina focuses on Medicaid and government-sponsored healthcare programs, areas that tend to be more stable during economic downturns. This could be Burry's way of balancing his portfolio with a defensive play, ensuring he has exposure to a sector that's less sensitive to market volatility. Finally, there's Olaplex Holdings, a much smaller addition to his portfolio. Burry added just 0.48% to his position, bringing it to 2.83% of the total. Olaplex, a company known for its hair care products, might seem like an odd choice, but it's likely a speculative bet on consumer spending trends. It's worth noting that the stock has taken a beating recently, so Burry could be looking at it as a value play. So what's the common thread here? If you step back and look at the big picture, Burry's recent buys show a strong focus on high-growth sectors and undervalued opportunities. He's betting heavily on Chinese tech, JD.com, Alibaba, and Baidu, while also diversifying into healthcare and fintech with Molina and Shift for Payments. This mix of aggressive and defensive plays suggests Burry is positioning himself to capitalize on both a potential global economic recovery and the continued evolution of key industries. Now that we've unpacked what Michael Burry bought and sold, let's zoom out and look at the bigger picture. Why is he making these moves, and what does it tell us about his overall strategy? As always with Burry, there's a method to the madness. It's all about spotting opportunities others might miss. First, let's talk about his heavy tilt towards Chinese tech stocks. JD.com, Alibaba, and Baidu now dominate his portfolio, making up more than 65% of its total value. Now, this isn't a casual move, it's a full-blown commitment. But why? Chinese tech has been under pressure recently due to regulatory crackdowns, slowing economic growth, and geopolitical tensions. For most investors, these factors scream, "Stay away!" But for Burry, it's like signaling opportunity. When the broader market is scared, prices drop, and that's when value investors like Burry start paying attention. He's betting that the long-term growth potential of these companies outweighs the short-term challenges. What's particularly interesting is that Burry isn't spreading his bets thin. He's narrowing his focus on a few high-conviction plays, which has always been his style. Back in the early 2000s, he famously made concentrated bets against the subprime mortgage market. That same laser focus is evident here. By concentrating his portfolio on Chinese tech, he's signaling strong confidence in the sector's recovery and growth potential. And let's not overlook his emphasis on innovation. Baidu, for instance, is heavily investing in AI and autonomous driving, two areas that could drive massive returns in the coming years. But Burry isn't putting all of his chips into one place. His moves in healthcare and fintech show he's also thinking about balance. By increasing his stake in Molina Healthcare, Burry is likely hedging against market volatility. Healthcare tends to perform well during economic uncertainty, and Molina's focus on Medicaid and government-sponsored programs makes that particularly resilient. It's a defensive play that complements his more aggressive bets in tech. Meanwhile, his investments in the Shift for Payments signals his interest in the growing fintech space, particularly as digital payments continue to expand in areas like e-commerce and hospitality. Then there's his exit from real estate and significant reduction in insurance stocks. These moves suggest that Burry is taking a dim view of sectors that are sensitive to rising interest rates and economic downturns. Real estate, for example, has been struggling with higher borrowing costs and slower demand. Another key aspect of Burry's strategy is his willingness to pivot. If something no longer fits his thesis, he sells. It's as simple as that. Alright, so what do these moves mean for you, the everyday investor? Let's unpack these strategies and turn them into actionable insights that can help you level up your investing game. First is finding value. One of the biggest mistakes many investors make is chasing trends or buying into stocks when the hype is at its peak. But real opportunities often lie in sectors that others are avoiding. Look at the Chinese tech stocks like JD.com and Alibaba. They've been hammered by regulatory crackdowns and economic concerns, which makes them appear risky. However, this pressure often leads to undervaluation, creating opportunities for those who are willing to dig a bit deeper. The best comparison is between Amazon and Alibaba, which is often called the Amazon of China. Both dominate e-commerce, lead in cloud computing, and power digital payments. Yet, while Amazon trades at a premium, Alibaba is heavily discounted due to regulatory fears and China's economic slowdown. But this doesn't reflect its fundamentals. Alibaba controls China's vast e-commerce market. It leads in cloud computing, and it invests heavily in AI and logistics. Despite similar growth and margins to Amazon, its price-to-earnings ratio is far lower. For long-term investors willing to look past short-term fears, Alibaba offers the chance to own a market leader at a deep discount. Here's the key: focus on the fundamentals. Analyze a company's balance sheet, their cash flow, and competitive positioning. Is the market underestimating its potential? If yes, this could be your chance to buy quality assets at a discount. Next, let's talk about portfolio strategy. Diversification is essential, but it's not just about owning a mix of stocks. It's about purposeful diversification. Don't buy 50 stocks just to feel safe. Instead, concentrate on areas you understand and believe in. This requires you to do your homework. For example, if you're bullish on a sector like renewable energy or biotech, identify its strongest players. However, balance is critical. Pair growth sectors with defensive plays like healthcare or consumer staples. Defensive sectors tend to hold steady during economic downturns, offering stability when high-growth bets are volatile. And most important is risk management, an area many investors overlook. Start with position sizing. Don't allocate more than 5 to 10% of your portfolio in any single stock unless you're highly confident and willing to accept the risk. Additionally, use stop-loss orders or mental thresholds to protect your downside. For example, if a stock falls 15 to 20% below your purchase price, reevaluate its fundamentals. Has anything fundamentally changed? If so, cut your losses. If not, it might be a buying opportunity. Another critical takeaway from Burry's strategy is adaptability. Markets evolve, and your portfolio should too. Ask yourself, does this stock still fit my long-term goals? Are there better opportunities elsewhere? If a position no longer aligns with your strategy, don't hesitate to sell. Remember, holding on to a losing stock because it might recover someday is not a strategy. It's emotional investing. Want to know the most recent stocks Warren Buffett just sold or bought for $35 billion? Click the video on the screen.